All right, thanks everyone for joining us again for the Employee Retention Credit webinar brought to you by Frost Law. Quick word from our sponsor. As the community bank of the nation's capital, United Bank is proud to be a sponsor of this What's Up Meeting webinar series. United Bank has been serving the greater Washington, D.C. region for over 30 years, providing a testament to their continued stability and reinforcing their position as a reliable banking partner. Backed by a history of safe, sound, and secure banking practices, United has navigated changing economic environments while staying true to their mission of excellence and service to their employees, customers, shareholders, and communities. They have the technology, products, and expertise they do expect from a big bank, but with the personal touch and local financial decision-making only a community bank could offer. They are proud to be the bankers you know and trust. For more information, visit bankwithunited.com. All right, and just as a reminder, if you have any questions, feel free to post them in the chat box or the question box, and we'll get to them at some point during the webinar.
How's that look?
Right.
Looks right.
Looks good. Peter has gotten to be an expert in PowerPoint slides. So that is a credential that will be on his CV very shortly. Thanks for joining us. We really appreciate it. I know it's tax credits and it's not like the most interesting, exciting thing in the world, but we promise you this one is worth your time and worth your attention. So Peter and I, our story is that we are tax controversy attorneys. We work with basically small businesses that are kind of on the bubble of viability that have tax problems. So payroll tax, sales tax, whichever it may be. And, we work with them through their challenges. So that way they can become viable. When the pandemic hit, we realized that these small businesses were about to get wiped out and they weren't going to be able to maintain operations. So Peter and I dug into the CARES Act and learned PPP and FFCRA. And, we spent a little time on ERC, but not a ton because you couldn't use the programs together. And PPP was such a windfall for businesses. We really spent our time and attention there. And as I'm sure you guys all know, PPP kept changing. So every 4 weeks, 5 weeks, whatever, Peter and I had new guidance and we had to figure out what the new rules for PPP were. And it became exhausting for some. It became exhausting for some CPAs and accountants, working through all this stuff. And then comes December 27th of 2020, and there's new legislation passed saying, actually, you know what, the pandemic is still ongoing, and we want to continue and help businesses and expand the ERC. You can now use it with PPP. And that's really when we started digging deep into the employee retention credit and how we were going to be able to help small businesses get these credits. And, some of our clients could even not pay their payroll taxes during the time, which is the first time and probably the last time you'll ever hear us say things like that to our clients. And then we kind of took a pivot and said, oh, we can actually use this information that we have. We spent all of this time learning it to inform, other businesses and other members of our community that aren't on the bubble of viability and hopefully are very successful. And they can also take advantage of this credit. So Peter is going to kind of go through the legislation and explain how we got here and what's the foundation of the ERC, and then we'll get into more details about the credit.
Yeah, we'll run through some of the boring stuff first. So Rebecca mentioned some of the stuff.
But hang on, don't go anywhere.
Yeah. It started with the Paycheck Protection Program. Early on, PPP was worth $15,000 and change per employee. ERC at the beginning, even if you could have gotten them together, was only worth $5,000. So PPP took all the air out of the room. Everybody was focusing on that. It changed multiple times and became even more lucrative. Second draw, all sorts of stuff. There was another program called the Family First Coronavirus Response Act, SFCRA. This was a program that if an employer paid wages while an employee was taking care of themselves because they were sick with COVID or taking care of an immediate family member who was sick with COVID, that employer could receive a credit for it. There were deferrals of employment taxes, specifically Social Security, employer portions of Social Security through 2020 that were then due 50% in 2021 at the end of the year and 50% on 12/31/2022. There was this little paid attention to employee retention credit that really nobody was looking at unless someone wasn't eligible for PPP. There was also, that came upon later, the Restaurant Revitalization Fund. There was a Shuttered Venues Operators Grant. And then there was this EIDL Economic Injury Disaster Loan, where basically the president declared every place in America as a disaster zone, and that made employers eligible to get some loans that were on very beneficial terms. Rebecca mentioned, ERC changed, right? So at the beginning, you couldn't get both. And, I think a lot of tax professionals, accountants, CPAs, not necessarily through any fault of their own, just haven't been up to speed on this, right? The first change came with the Taxpayer Certainty and Disaster Tax Relief Act, generally called the Relief Act. That was December 27th of 2020, right before these tax professionals were going into prep season for 2021. Then after the administration changed, on March 11th, they signed into law the American Rescue Plan Act of 2021. People call it ARP. That changed it again while these folks were still in the middle of tax prep season. You give your preparer a couple of months to sort of relax, take a vacation, and maybe they're sitting down during the holidays and they're going to try to catch up on all this stuff. And then, Infrastructure Investment and Jobs Act, November 15th, 2021, changes again. For the third time after the initial. But basically, the trend has been to make the credit more lucrative and easier to get, and they've also added additional quarters that initially weren't available. Just so you know, we're not making this stuff up. There have been, guidance that has come out from Treasury, from IRS. Notice 2021-20 is the big one. Each of the three subsequent ones sort of track the updated legislation. There have been revenue procedures that have come out. Leaves us wanting a little bit more. But the basis for the conversation we're having today is based on these notices. They don't address all the issues, but they address some of the big ones. And then before I throw it back to Rebecca, just some payroll tax basics. So if you did PPP, your experience was that you made an application with, a bank that you had an existing relationship with, or in some cases, maybe created a relationship with a fintech firm, and you were sending them financial information, whatever information they asked for. On the flip side, when you went to go get your forgiveness and you filed your 3508, that was again to the bank. And the bank asked for information to corroborate some of the positions that you took, depending on your situation. That's not what's going on here. So this is a tax credit. It's firmly within the Internal Revenue Service. It is built on existing IRS law that we'll go through, but this has to do with your quarterly Forms 941 that you file. And the taxes that you otherwise self-assess on those, your FICA taxes, your Medicare, Social Security, that both the employee pays a portion of and the employer pays a portion of. So that's, the credit itself is based on wages paid, but it is a refundable payroll tax credit at its core.
Dramatic pause. Okay. So that's how we got here. That's the baseline of all that stuff. But what is it? What are we talking about? This is an employee tax credit, a refundable tax credit. So it's a check. This is the important part, right? It's a check written to your business from the government for each quarter that you're eligible. There are two different amounts basically on how to be eligible, 2020 and 2021. For 2020, an eligible employer is allowed a credit against applicable employment taxes equal to 50% of qualified wages for the entire year. So plainly, that's $5,000 per employee. For 2021, in this process of changing legislation and getting more business friendly and all that stuff, they were like, this is not enough. $5,000. We're going to make it 70% of up to $10,000 per employee per quarter. And, it's 2 and then 4 and then 3, but now it's 3. So just remember that, unless you're a different kind of employer, and we'll get there. But, so that could be up to an additional $21,000. So that's how we get to $26,000. If you get $5,000 in 2020, and then you're eligible for all 3 quarters in 2021, 70%, $10,000 in wages, $7,000, 7 times 3, 21. And then we get 26. So you could possibly get up to $26,000 per employee for your business. So even if you have 4 employees, it's not a bad day. For places that have more than 4 employees, that's obviously a pretty good day. So this is why we're here, and this is why we're explaining it. This is a very lucrative tax credit. How do you get it? You have to be an eligible employer. What does that mean? You have to be carrying on a trade or business during the calendar quarter for which the credit is determined, meaning you have to be operating. And more dramatic pause. Okay, there's 2 ways to qualify, either through a gross receipts test or a restrictions test, like full suspension or partial restrictions. Gross receipts test is the easiest way. First, we check and see whether or not you qualify based on gross receipts. For 2020, remember, this is the less business-friendly version of the bill, 50% decline in gross receipts, quarter over quarter, from 2020 to 2019. For most businesses, if it was a COVID reduction, and for retailers, if you're non-essential, this could be you, because you went from being open all the time to having to close your doors in Q2 of 2020. So your gross receipts might have gone down 50%. Once you're down 50%, you continue to be eligible until your gross receipts go back up to 20% decline compared to 2019. For 2021, it's easier. All you need is a 20% decline in gross receipts, quarter over quarter, 2021 compared to 2019. And there are alternative reference periods, meaning that if Q1, I'm down 20%, Q2, my revenue went up the wall, up the chain. I'm not sure what I'm trying to say. Went high, increased. You would still qualify for that second quarter because of that first quarter, the previous quarter decline. You don't have to have any reason for a gross receipts decline. It could be because of COVID. It could be because you lost a contract. It could be because you closed a location. It doesn't matter. Gross receipts test does not have to be tied to COVID. It's just a revenue decline. And this is top line revenue. It's not profits or anything like that. That's one way to determine if you're eligible, and it's the easiest way. We always tell everyone to start first with gross receipts. If you're eligible in gross receipts, we don't have to do anything else. The other way to be eligible is through a full or partial suspension. So the operation of your trade or business is fully or partially suspended during the calendar quarter due to orders from an appropriate governmental authority limiting commerce, travel, or group meetings due to COVID. So this one has to be because of COVID. It has to be tied to a government order. Now, what does it mean to be full or partially suspended? Full suspension is pretty easy. You're not allowed to be open, right? And for retailers, you guys weren't allowed to open your doors. You could do online sales. You could do things like that. At certain points, they started doing curbside delivery. All of that's going to be considered suspended operations. Partial suspension is where you're going to kind of be in the weeds and determine whether or not you are eligible. So the test for this is to determine if your business, say it was essential, you're required to be open, you're allowed to be open all the time. Like law firms were allowed to be open, but we couldn't do certain things. We couldn't go to court. We couldn't hold a training in our training room for 30 people to discuss, tax credits or anything else with new attorneys. There are certain ways the government was limiting your commerce, the way you were acting. And that can either be limited in terms of hours worked or in dollars in the door. And both of those are going to be a 10% test compared to 2019. So what that means is if the government said, okay, you can be open, but due to your square footage, I'm only going to allow you to have 5 people in your store at a time. And you typically would have had 20 people in your store at a time. It's possible that that would be more than nominal, more than 10% of your 2019, like I said, revenue or hours worked for that quarter, and therefore could be eligible. So for restaurants and things like that, it's pretty easy. Your dining room is restricted 50% capacity. You can seat 50% of the people. You are going to hit that 10% mark. It's not going to be that challenging. For retailers, we're going to have to really look and talk to you and discuss, okay, what is your business model? How many people typically are in your store? How many people are in your store at like during this period of time? Were there long lines outside? Did you find that like it normally you would have had foot traffic? You didn't have foot traffic because of the limitations, things like that. We would need to go through all of that information to make a determination. But it's very possible that you are eligible based on these restrictions. So there could be supply chain issues, change in customer demand, and short waits. Those are probably not considered
Right. So
suspension.
I'll jump in here. I added these.
I was like, this is a new slide.
I added this stuff on Rebecca. Look, the Notice 2021-20 has, I don't know, 60, 70 Q&As that sort of flush out how this stuff works. And in a couple of them, they talk about supply chain. Supply chain issues could result in a qualification, but you always have to go back and you have to find the actual governmental order that is creating the supply chain issue. If it's just because you couldn't get someone to come to work to drive the truck to deliver the product, that's not going to be enough. If it's because you couldn't get a shipping container to ship the product, you know, or the raw material to create the product that you're ultimately going to sell, that's not necessarily something that is due to a governmental order in response to COVID. So while those things may have affected you, it's important to slow down and just work through and find the governmental order. I know Rebecca had one client who we actually did get comfortable qualifying based on a supply chain issue because they couldn't access a part of a product that needed to be added to the widget they were creating because a warehouse was closed in New York, right? There are going to be governmental orders that are out there that do not necessarily directly affect retail operations, but they're changing the behavior of customers. If it is something where someone doesn't want to wear a mask and therefore they choose not to come, you know, to your store, that's not going to be a governmental order that is going to qualify you. You just want to make sure that it's an order that is impacting your business and not just changing customer demand. The last issue to work through, and this is a challenging one for a lot of retailers, is, you know, you may have had governmental orders that deal with capacity and, you know, or a one in, one out situation. And the question is, you know, if you could service the same amount of people or a similar amount of people after a short wait, you know, while you were working with another customer, you know, where do you draw the line there? And so I think taking a minute and working through this with a tax professional or someone who has some familiarity with this stuff is going to be critical, especially for retailers, because I think that a lot of you may qualify, but you're going to need to work through some of these issues to make sure that you're comfortable signing the tax return. Rebecca, do you have anything else to add, or do you want me to move on?
I did just quick. So Peter told you to go and look at the orders and for you to do this legal research. You can also call like your tax professional and talk it through with them or talk it through with us. I mean, we've gone through a number of these. Certainly, we've got clients in Annapolis and Anne Arundel County. It's a pain and it's not super clear, and it may be something that's worth, you know, calling a professional about. That would be my thought. And then just like one final thing is like when we're putting together this when we do it at our firm, I'm sure other places do it similarly. We actually write an opinion letter that says like, okay, this is how they're eligible. Here is the language in the CARES Act. Here's the language in the Relief Act. This is the government orders that are restricting this commerce. And here's how this business typically operated in 2019, and then how it had to change. So whoever you get to help you with this, I would say make sure that they're putting together something for you that you can rely upon and feel comfortable with as far as like why you're eligible. So that way, you know, you're doing it properly. And if anything ever happened in the future, you were able to substantiate your claims.
Yep. So Rebecca said there's two ways to qualify. There's actually a third from the American Rescue Plan. It came along late in the game, but it's the idea of this recovery startup business. So a recovery startup business is a business that by definition began operations after February 15th, 2020. So if you started on February 15th, you can't be a recovery startup business. And if you started on February 16th, you can. It's just a choice Congress made. You have to have the average gross receipts of the business be less than $1 million. And then you don't qualify under methods 1 or 2. So that's the gross receipts test or the full or partial suspension. Lastly, the credit is only available for quarters 3 and 4 of 2021. So a couple of points here. First is that you can qualify by any of the methods, and it's a quarter by quarter analysis. So you could be suspended in one quarter and have that partial shutdown. You could have a reduction of gross receipts another quarter, and you could also have a situation where maybe you started after February 15th and you can be a recovery startup business. The really nice thing for recovery startup businesses is that you are the only people who can qualify for quarter 4 of 2021. And so basically they're just rewarding somebody who took a chance and basically started a new company during a pandemic, and then you survive to pay wages in quarters 3 and quarters 4 of 2021. It is capped at $50,000 per quarter. So you're going to want to try to qualify under a gross receipts test or a full or partial suspension test in Q3 or 4. But if you can't, there's still that added opportunity for up to $50,000, and so total of $100,000 for those 2 quarters as a recovery startup business. These next couple slides, or I guess the slides through to the end, are sort of, okay, what's the catch, right? This all sounds really good. I'm getting $26,000 per employee, and I can't wait to get these 4, 5, 6 checks from the government. What we've talked about so far is just that you're an eligible employer, but it doesn't necessarily mean that you paid any qualified wages or that you're actually going to get any credit. So we'll go through the qualified wage analysis and then talk through some of the places where you need to slow down and work through some of the trickiness on this. So the first one is qualified wages. There's 2 different rules depending on whether the wages were paid in 2020 or 2021. And just as a reminder, sort of the maximum qualified wages that we're talking about here is up to $10,000 for all of 2020 or $10,000 per quarter in 2021. And we're just trying to figure out, okay, well, what are the certain things that could throttle back my 10,000? What am I not going to get credit for? The first big one is that if you had more than 100 full-time employees in 2020, and I'll just flip to it, but more than 500 full-time employees in 2021. So there's a 2021 rule and a 2020 rule. Again, following the general trend line of making this more lucrative and more available, they bumped it from 100 to 500. So the catch here is that if you had more than 100 or more than 500 employees, the only wages that are going to be considered qualified and therefore available to use for the purpose of the employee retention credit are those wages paid to someone who is not providing service to the company. So you had to be paying them to stay home. The good news, I guess, is that it's not a cliff, right? So you could be paying someone both to provide service and not to provide service. If you just needed someone, 15 hours a week and not 40 hours a week, but you still paid them the 40 hours per week because you knew they had kids at home or whatever the reason or no reason, you just paid them the full amount. The 15 hours that they were, actually providing service, that's not going to be considered a qualified wage. But the amount that you paid, to not provide service, that additional 25 hours, is still considered a qualified wage. A couple other comments about qualified wages. One is that tips for restaurants count, even though the business never actually paid those tips. The other nice thing is that health plan expenses, which is basically employer covered pre-tax health insurance premiums, can also count as a qualified wage. And just so you know here, we're only talking about full-time employees. We're not talking about you doing some full-time equivalent Affordable Care Act type computation. It does grab the definition from the Affordable Care Act. So we're talking about full-time employee is someone who works 30 hours a week or 130 hours per month. If you are close to these 100 or 500 benchmarks, it's a good opportunity to slow down and work through the numbers to confirm your eligibility. And with that, whether or not she knows it, I'm going to pass it back to Rebecca.
I do know it. I've gotten way better at knowing my spot, except for when you add slides I'm not aware of and they don't have context. Okay, so just to kind of recap and make sure you're all following along, we are talking about a refundable tax credit, which means not a credit you're carrying forward for 20 years, but you're getting a check in the mail to your business. Our clients are literally getting checks like often. I called somebody yesterday, their checks are being sent now from the government. You're getting more than what you paid. So when we say 70% of $10,000 in wages, even if your tax is less than $7 grand per employee, which it will be, then you are still getting your dollars in the door for your business. So that's really important. You're getting a check from your business. Secondly, it can be up to $26,000, even if you paid less than what you put on the 941. So you're going to get more money than you gave to the government. The way Peter was explaining the 941 before, like this is just the government mechanism and the way for them to give money out. They were like, how do we help businesses right now? There's a pandemic. We'll use the banks and SBA legislation, and we'll use Treasury. This is just a way to get it out. So now that we're all still here. So amount of qualified wages credited by the eligible employer cannot exceed $10,000. A recovery startup business, that special thing that Peter was talking about, you can get up to $50,000 a quarter for that. So that's just kind of like, if you don't qualify any other way, there were no restrictions, but you're a new business. The government feels bad that you started a business during a pandemic. So they want to give you, a gold star for that. They're going to give you a small credit. And this is the refunds of the excess credit. This is what I'm talking about. It is to you like cash in hand. So that's the most important part, I think, to understand. What you cannot do is use the same dollar twice. So as the legislation was coming through, where you could use the ERC and the PPP and FFCRA, you could use all those programs, but you can't use the same dollar more than once. So if I paid Peter $25,000 in 2020, I can use $20,000 for PPP, but then I can only use $5,000 of his wages for ERC. For 2020, it probably won't matter all that much, but for 2021, it will. You need to actually create a work paper, or this is what we suggest, is you create a work paper and you have like Peter Huckabo on your Excel sheet, and you say, okay, here's his wages that were PPP, here are his wages that account for ERC, here's his FFCRA wages, and if you have anything left over. So that way you know exactly how much you're able to include in your qualified wages analysis. Again, I kind of talked about like the package that we put together. We do a full work paper and you get that when you get your 941s. So that way, if the government does come, you can show this is how much we believed we were entitled to because this law firm said we were. And this is why. This is the, the eligibility analysis that we're doing in that letter. So you have that. If, and by all means, go to your CPA, go to whomever, just make sure that they're doing this type of analysis and that you're getting the work papers when they do it. And make sure someone's being careful and not double counting wages. You can't do PPP and FFCRA and pay somebody $5,000 13 times using different government programs. Pretty much it. How do you get it? This is still me. You claim it on the 941. Peter's heard this a few times. I hate the 941. I'm not a fan. First time I had to do it was when I got a nanny in 2014. And I thought it was miserable. And they've made it like 3 times as long now with all of these credits and workouts and worksheets and backouts and whatever's. It's gotten worse. So the 941 is how you're claiming this refund. So for you all, since we are past the eligibility period, it's going to be the 941X. You're filing an amended payroll return and you're going to have to paper file that with the IRS. This worksheet up here is how you calculate what the credit is based on the eligible wages. Those work papers are going to need to be included in that packet that you're keeping for your records. So you're going to have this work paper, you're going to have your PPP work paper, and you're going to have that opinion letter. And also like your government orders, you're going to want to have all of that together, and Peter kind of will go into why. But this is how you get it. You file the 941. How far back are they now, Peter? 4 million?
3.8, I think is the last I saw.
Peter gets like a little ticker tape of how many payroll returns that the IRS is behind each day. It was like 9 million like a couple months ago. So they're really making progress. And I feel like now it's taking about 5 months to process these claims, 6 months, whereas before it was going on 12. So we're making progress, and hopefully as we keep filing them, the newer ones will go through faster and faster.
All right, so what do you need to substantiate the credit? And, going back to PPP, there were so many folks who were saying like, what are the banks going to ask for? I'm nervous about this forgiveness. What do I need to get? Are they going to deny my forgiveness? Am I going to have to repay this loan? And Rebecca and I would guess what they would ask for. We would tell them what we would ask for if we were trying to investigate whether or not you did your 60% for payroll and 40% for non-payroll and all that kind of stuff. This is actually built into the legislation. They told the Treasury Secretary to tell us what they want to see. And so whether you do it yourself or you work with another tax professional, these are the types of things that you need to get. So if you are qualifying in any calendar quarter based on a full or partial restriction due to a governmental order, you got to find the governmental order. And that can be tricky in some situations because, you may have first started with what Governor Hogan put out. You may then have to drop down to a county level and figure out if one of the county executives did something more, or if one of the local health departments did something more in what the governmental orders that they put out. It can be federal.
County had was less restrictive than Annapolis was. I think Annapolis actually extended 2 more months.
Mm-hmm. It can be federal, it can be state, it can be local, but while these things are still posted online and available, you want to go and you want to find them and you want to keep them in a safe place for a number of years. If you qualify because of a reduction in gross receipts, you're going to want to maintain records to show that you had a reduction in gross receipts. Remember, that is going all the way back to 2019 and 2020 and 2021 potentially. So you're going to want to maintain, those records. The purpose of this, and we'll get to it, is that these things can be audited. I mean, this is still within Internal Revenue Code, and government can audit your tax return. Records of qualified wages. This, I think, really goes to, it goes to showing that you actually paid people. But if you are a large employer, again, 100 full-time employees or 500 full-time employees, they're especially going to want to see some, explanation for, I was paying these folks to work and I was paying these folks not to work. If you are using health plan expenses as qualified wages, you're going to need records related to those. If this documentation of aggregate group employer determination, we'll get into it on the next slide, but there are situations where you're going to have to grab information from affiliated businesses that together create what's called a controlled group. This next one, copies of a completed form 7200. 7200 was in advance of the credit. In my experience, I don't think anybody got the advance. It was a nice idea where you could actually ask for the credit before you actually had to go and file your 941. I don't recall anyone actually benefiting from that or that actually, working. Then keep a copy of your tax returns. Retain the documents for at least 5 years. So then there are a couple of additional catches, special issues that we should discuss. So ownership aggregation rules may apply. The question that really needs to be asked is, do any of the owners own other businesses, or do any of the owners' immediate family members own any of the businesses? These are situations where, you could have a retail shop and maybe have a restaurant too. And if the ownership groups are similar enough, you may have a brother-sister control group. Or you may have a situation where a company owns a retail shop, but also owns a coffee shop. And depending on the ownership structure, you may have a parent-subsidiary relationship. In these situations, you may have multiples and both parent-subsidiary and brother-sister. And so if there's multiple ownership, either among the owners of the business itself or family members, you need to slow down and work through these issues to make sure you're qualified. It can be a good thing in that, your partial suspension of your retail may qualify, an affiliated business that otherwise wouldn't be qualified. And so you may get, because they're treated as one employer for all purposes of the employee retention credit. If you have that going on, slow down, talk to a professional. These are existing ideas within the Internal Revenue Code. It's nothing new, but they're challenging. Majority owner wages are not considered qualified wages. In addition to that, there are situations where someone can become a deemed owner, typically because of the familial relationship and their wages. So if you have kids, grandparents, aunts, uncles, those close relationships working in the business, slow down and make sure that you're appropriately counting their wages. If you acquired a business during the pandemic, there are special rules, including a safe harbor for how to think about their gross receipts. Sole proprietor income is not eligible as a qualified wage, and this is okay. This is providing parity with the 50% plus one owner majority owner rule, but this is different than PPP, right? PPP, if you were a sole proprietor filing on Schedule C, the banks were asking for your copy of your Schedule C line 31 net business income, and you were able to borrow based on that. That's not what's happening here. That's not going to be considered a qualified wage. But that said, a sole proprietor can still pay wages to employees. So if you still have employees, it's not all is lost. It's just creating parity with the rule that a majority owner is not able to claim it based on their wages. Next, sorry to Rebecca's nanny, but the household employers are not eligible. That's just the choice that Congress made. The assessment statute of limitation is expanded to 5 years. It's typically 3 years on some of these quarters. So be aware that you're going to want to retain records for longer than you normally would. The refund claim statute is not extended, but you still have over a year to make these claims. But again, Rebecca mentioned some of these are taking 12 and 13 months to process. We filed some at the beginning of this year that we're starting to see go through. So 5 or 6 months, things we hope are getting better. But nothing's happening too fast. So, you know, if you think you're eligible, I'd be working on it as soon as possible. It's a little bit different. Like, it's not like PPP, which ran out of money, or you know, the restaurant revitalization fund, which ran out of money, or something like that. But still, you're going to want to get in line. Sooner the better. Then the last big catch is that there's an existing code section called 280C. And section 280C basically says that if you get a tax credit based on wages paid, you have to reduce the amount of the wages that you deducted on your tax return by the amount of the credit you received. The trick here, or the issue here, is that hopefully you've already filed your 2020 tax return and at least gotten an extension for your 2021 tax return. So as a result of receiving the credit, you should go back and amend your business tax return. That may have the added consequence, if you're a pass-through entity, of amending a Schedule K-1, which is then going to trickle down to one of the owners, and you know, they're going to have to amend their 1040. Sounds like a lot of work. It's really not. I mean, if you figure out the credit, you're really just changing one number on a tax return, or sending your preparer, you know, saying, hey, reduce this one number, and the software is going to pick it up pretty quickly, but it's going to result in taxable income. And you're going to end up paying tax on the amount of the credit. That said, going back to Rebecca's earlier comment, this is a lot of money. It's blowing past the tax you owe, and it's coming back as a refundable tax credit. And even if you end up paying, you know, 30%, whatever your you know, tax rate is, it still makes sense to do. And you know, these are tax credits that are going back into the business. It is not like PPP, where you have to turn around and use 60% of it on, you know, wages and or payroll, and 40%, up to 40% on non-payroll taxes. This is just cash into your business that, you know, no strings attached. It's just a refund to you. So even though you need to go back and amend your tax return, in almost all circumstances, it still makes sense to do. I can envision a scenario where the credit is just so small that all the effort that's going to go into qualifying you know, may not be worth it. But I think that those scenarios are, certainly in our experience, are few and far between.
So that is the credit. That is how you get it. Let us know. Like I said, this is something that we have spent. Luckily, I don't have a tally of all the hours that we've spent on this, because I'd be sad. But we've spent a lot of time, and it's not something that's going to be around forever. So we're happy to help. You know, if you've got like a quick question, or you want to spitball something, you know, we're happy to do that and talk you through it. So
there's just one.
Yeah, go ahead.
There's one question. Just, is the owner's salary eligible? So and there's more, but I'll stop there. So it's important to understand, you know, is the owner a majority owner? If the owner is a minority owner, 50% or less, then yeah, I think that they can still have a qualified wage. If they are a majority, though, that will not be a qualified wage for the purpose of the credit. The second part of the question is, how about immediate family members? So it's really a question of, does a majority owner have a family member who is working in the business, and therefore that person becomes a deemed owner? And if that is the case, then no, that immediate family member's wages would not be considered qualified.
Any other questions?
And our contact information is here, so feel free to reach out. Those are our email addresses. We're at askfrost.com. Here's a bunch of telephone numbers.
All right, well, it doesn't look like there's any other questions. Thank you to you both, and
Thank you so much.
we'll be back next week.
Take care. Thank you.
Great, thanks.
Bye.